Hello, welcome to the special edition of the Global Market Outlook for 2018 with me, Tanvir Gill. GMO, a global asset management company that has over $80 billion assets under management, has been very active in investing in emerging markets over the course of the last 2 decades. In fact, more than 2 decades at that. And Arjun Divecha, senior partner at GMO, has been the man behind GMO's EM strategy for 25 years, for over 25 years in fact, and he joins me for an exclusive chat. Mr. Divecha, it's great to have you on the show. Thanks very much for taking out the time.
Thank you, Tanvir. Always a pleasure to be here.
And great to have you in Mumbai.
Yes, absolutely.
Welcome back. You come here for your annual visits.
Yes.
How's it different this time?
Well, it's not that different. I mean, obviously, Bombay is
home for you.
Is home for me, and you know, in some ways, what I find is that South Bombay, this part of town, doesn't seem to change that much, and so that's always a positive. But basically, as I see it, you know, one of the questions I came here to try and answer for myself is that I've been kind of very bullish on India for the last 2 or 3 years in terms of the economic growth, and in many ways it has disappointed in many ways. And so part of the question I'm trying to answer for myself is that why is that? Why is it that India has kind of disappointed from a growth point of view? And what are the factors that have led to that? And
what are the sound bites that you're gathering on that? Because, you know, you have the benefit, Mr. Divecha, of living overseas and looking at the India story objectively. You know, a person dealing with this, with the in and outs of how this economy is being run on a daily basis may not have that view. So in your conversations with your peers and friends, since the last year to now, given that there have been a slew of reforms over the last 12 months, how much has changed, and how are they looking at this growth slowdown or growth not performing to potential at this juncture?
Sure. So from a long-term point of view, one of my basic theories about India has always been this, that India has a relatively high savings rate. The problem is that the transmission mechanism from savings to investment has always been problematic because of the problems of the banking sector. And so that is kind of what needs to be fixed. And so part of the reason why, in my opinion, growth has not kind of come through is that it's still broken. And again, we can talk more about, you know, what about the bank reforms and things like that. But at the end of the day, I think that the positives from India, from my point of view, have been, number one, that you've had a number of reforms put into place, like GST, like the bankruptcy law, like real estate. You know, so a number of economic things which we see are positive. We have a fiscal deficit which is kind of under control. You've got inflation relatively under control. You know, so all the ducks are in line. And so that's why I've been kind of excited to see this economy take off. But at some level, what in my opinion, the economy is lacking is what John Maynard Keynes calls animal spirits. That is, you need something to get this cycle going. And I've kind of theorized in my mind that perhaps this bull market will be that. That is, you know, enough people, the wealth effect created by people becoming certain wealthier will then cause investment and things like that. But I'm not sure we're seeing it yet. Maybe it's starting to turn around, because you had a couple of hiccups with the demonetization and the GST introduction. You could say they were hiccups which kind of slowed the economic growth
and
down.
many are saying that at 5.7 we've seen the worst, which was the last print on GDP, with 6.3 coming in, that, you know, now it's that revival trend that the economy is going to see, which is going to take us to, you know, our potential of 7.5%, 8%. Is 8% the potential that you see, or beyond?
I think 8 is probably sustainable. I think certainly in a cyclical fashion, you tend to go beyond your speed limit, you know, so you could go from 8 to 10, but it's unlikely you can sustain 10. I think between 7 and 8 is what I would consider to be kind of the long-term sustainable growth rate, or the speed limit, so to speak.
Talking about growth, what's happening with the US? 3.3%, their last growth numbers. You know, you're based out of California. You know that market inside out. You know the economy, what's, you know, how things are turning about. Is it sustainable? Is it real? Is it inclusive?
Well, 3.3 is a high number. I don't think that US can sustain that kind of number for a long period of time. Because if you think about it, what is economic growth? Economic growth, if you think of GDP growth, is a combination of two things. It is the participation in the workforce, so to speak, that is labor force, plus productivity growth. The sum of those two is GDP growth. So in the US, essentially we have reached a point where additions to the labor force are pretty close to zero. So therefore you're not getting the population growth. So therefore, to say that productivity growth can grow at 3.5% a year for a long period of time, That's really not possible. Basically, if you look at the long-term history, about 2% is what is really feasible. So we think in the long run, about 2% is perhaps the kind of the speed limit, so to speak, for the US economy.
But that's sub-part of the previous growth cycle, Mr. Divecha, because I remember the average for the cycle, the economic cycle that is, between 2002 to 2004-5 was, at one point in time it peaked at 4%, but 3.5% was the run rate at that point. So
but remember, the demographics have shifted. Okay. That is basically what you've had in the last 10 years is a peak in the demographic cycle, where the number of additions to the labor force have now essentially
the participation rate has fallen.
That's
most
correct.
Definitely. I also, so what does the market, the bull market in the US reflect? What does this market rally reflect? Because every single day we wake up in the morning and we're like, okay, what are the cues from the US? Record highs.
Right.
Right.
Yeah.
It's just not stopping.
Correct.
And that just reminds me of the newsletter that GMO put out at the end of Q2, authored by Ben Inker as well as Jeremy Grantham, saying, trying to answer two questions. One is, why are stock market valuations so high? And secondly, why do fund managers continue to buy such high valuations?
True.
Explain.
Well, I think there's two contradictory things over here. One is that clearly market valuations are high. There's no question about that.
Yeah.
But one of the things that we've done a lot of work on is trying to explain what explains valuations in markets. And it turns out that it's a lot of what we call comfort or psychological factors that tend to drive the level of valuations. So when inflation is low, when corporate profits are high, when volatility of growth is low, markets tend to like that, and so PE ratios tend to be high there. And that's the case. We're kind of in a Goldilocks kind of scenario where all the things are, there's no sign of inflation, growth is good, etc. So it makes sense that markets should be expensive, from a psychological point of view. Now, my view is that part of what has driven this market, certainly in the last year, has been kind of the prospect of tax reform, and that has been a force that I think that a lot of investors in the US have been looking towards. And in fact, just today, if you saw, the Dow was up like 300 plus points, because in some sense they are seeing that, well, they're getting closer to getting this tax reform done.
Yeah.
So I think
So what happens when it's done?
Well, that's a very good question. I don't know.
Okay.
Now, even within our organization, we have different kind of views about what's really going on with the market. So Jeremy Grantham, for example, believes that we are on our way to a real full-fledged bubble. Now, people talk about this as being a bubble, but it's not yet a bubble. The valuations are not at bubble levels and things like that. We haven't seen all the signs of a bubble yet. So Jeremy believes that we're getting there, that before you see the end of these things, you will get an acceleration. That is, the last phase of a bull market is always an acceleration. And so, for example, one of the statistics that he cites is something which is called the advanced decline line, which is in some sense how many stocks are making new highs versus not new highs.
Yeah.
In 2000, during the previous tech bubble, that peaked a good year to 2 years before the market peaked. So what happens when you get to the end of a bull market typically is the breadth gets narrower and narrower. That is, fewer and fewer stocks are making the running. Whereas that is not true today. Today, it is a fairly broad-based market. So Jeremy believes fairly strongly that we're not yet at the end of of the cycle.
So since this show is really about your outlook into 2018, does GMO believe that into 2018 we're going to be seeing more of the same? That means a fantastic 2017 is going to follow into a fantastic 2018.
I don't know. I mean, quite frankly, Jeremy is one of the smartest people I know, and so I find it hard to discount what he says. But on the other hand, I basically believe that you have a situation where you don't really know what will cause overvalued or highly valued markets to essentially, decline. So I don't know what those factors will be.
One more aspect which is being attributed to why we could be on the brink of a sell-off is liquidity conditions tightening, with central bank policy normalization happening in the US, Bank of England. Even though they did not really need to hike rates, they had no option. Growth was undershooting, is undershooting in the UK, but inflation has picked up suddenly. So everybody's talking about inflation being this devil, which will suddenly rise in 2018, and then they will have to move faster on making liquidity tighter to control that.
It's true, but if you look at the last 10 years, if you'd asked me 10 years ago, if the central banks are putting all this money out there and doing all this kind of stuff, won't this ignite inflation? I would have said, of course, right?
Yeah.
But it didn't happen.
It didn't happen, yeah.
Then
that's true.
it was, okay, they're going to stop QE, and that's going to basically cause all these problems. Again, there was no problem. Then it was, okay, now they're going to reverse QE, and they're going to start buying back stuff, and that's going to basically cause problems, but that hasn't happened. So, quite frankly, I don't think anybody knows what are the implications of the central bank policies over the last 10 years. It's been a grand experiment, and I don't think anybody predicted what actually happened, and therefore I don't feel like anybody's in a position to predict what might happen as a result of that. Certainly, I think, given everything that we know from an economic point of view, you should start to see inflation at some point, but we certainly don't see it on the horizon yet.
So it would be a calibrated move by the Fed into 2018, you know, go slow and steady on rate hikes, and do the unwinding of the balance sheet also in a very, very measured manner so as to not spook the markets.
I think that that's certainly the case. I mean, I certainly think that the new chairman of the Fed is going to continue Yellen's policy. So I don't think you've got some new radical person who's going to dramatically change how we do things.
At an index level, at a country level, are there any broad value calls? Like, you know, does India fall into the value zone? You believe India is expensive at
India is expensive. There's no question that India is
You've
expensive.
taken some money off the table from India in the last 6 months.
We have. We've been quite long India for the last 2-3 years. And again, it comes back to what I was talking about earlier on, which is that we've been enthusiastic about India because we felt all the ducks were in line for a really good economic expansion. The fact that we're not seeing that, but the market has been anticipating it. So the market has continued to go up while the economic reality hasn't quite turned yet. So we've taken some money off the table. We still like India. I mean, it's not that we dislike India, but we've taken some money off the table in India.
So which are the other countries where you find value?
Well, as I said, Taiwan is really probably our biggest bet right now.
Okay.
And specifically tech stocks in Taiwan. It's a very interesting story. So the tech stocks in Taiwan are kind of fall into 3 categories. They're kind of the assemblers. That is the people who make stuff like Honhai, who make the iPhones, or Quanta, who make MacBooks. So that's one group. The second group are the foundries, which is things like TSMC, the people who make the chips. And then there are about 30 companies who are what I call the middlemen of the tech industry. They make the substrates, they make all the components that go into iPhones and things like that. And it turns out that this entire group of stocks is trading at 10, 12 times valuations, in some cases paying dividend yields north of 7-8%. But here's the really interesting thing about them. These are all very highly capital intensive businesses which have no debt. That is, they're extremely good stewards of capital. And the reason why they are cheap is because basically the market believes that between Apple on the high end and kind of the low-end Chinese manufacturers on the bottom end, that their margins are going to get squeezed.
Right.
And yes, that will probably happen. But at the end of the day, these people are survivors. These are the people who are making components for mini computers back 20 years ago. They were the people making disk drives, And 10 years from now, they'll be the people making components for self-driving cars or for robotics and things like that. So that's why these people are survivors, and so we like them a lot.
Would you say that, if you were to allocate incremental capital coming into your fund within emerging markets, that you would choose Taiwan, China, and Russia over India?
At this point, yes.
Okay, so then my question, this Moody's upgrade, this historic upgrade that's come in, and Russia is in junk zone right now. The Chinese credit profile was also, I believe, downgraded from the level that they were at. Of course, still having high quality investment grades attached to most of their loans and the credit profile there. What does the Moody's upgrade signal for India, or what is, let me rephrase that, what does the Moody's upgrade reflect about India to the rest of the world, which can put it at a bit of a plus compared to other emerging markets? And a lot of them, Mr. Divecha, have been downgraded over the course of the last 2 years, right? Whether it's Russia, whether it's Turkey, whether it's South Africa, Brazil, they've had serious problems. So how does this really help India?
Well, as an equity investor, it's not clear to me that it helps a lot because of the fact that a lot of this is anticipated. I mean, you could say that the rating change is not signaling something that's going to happen. It is basically confirming something that has already happened. And that is in some sense that India, from a fiscal point of view, has actually done a fairly good job. And quite frankly, it has benefited from the fact that oil prices fell from $100 down to 50. Let's be clear, if oil prices were still at $100, India might not be looking so good from an economic point of view.
Yeah, but the contra view there is that the new reality with oil prices is, we're going to have low oil prices. So why look at a scenario which is now part of history?
No, I agree. All I'm saying is that India did in fact get a nice windfall.
Yeah. We got lucky there, which is fine.
Yeah, and that's why.
But that's the luck that we need to play with right now, because that luck may be the new reality. You think the market has, with its current price action, already captured the upside that a Moody's upgrade can bring about?
I think so. I mean, look, my view about a Moody's upgrade is that it largely reflects the ability of people to pay.
Yeah.
I don't think anybody has had any doubts about the ability of Indian corporates or the sovereign to basically pay.
How do you look at the India story? And I want to come back to that fact that, you know, for India's growth potential to reach a sustainable level of 7.5%, 8%, what do you hope to see in India happen? Because we've had very major reforms over the course of the last 12 months.
Absolutely.
Key reforms, landmark reforms, game-changing reforms. I mean, you can use as many adjectives to describe that. What will change henceforth for you to believe in India again?
Well, I'd like to see the impact of the reforms come through. I mean, obviously it takes time before the reforms start to really act. So we'd like to see that. But at the end of the day, I believe what India really needs is a massive infrastructure spending project, massive infrastructure-led growth. And I think that that's something which the government actually has some control over. The government has no control over whether private industry decides to invest or not. That is really up to each individual, entrepreneur and industrialist to decide, is there the demand for me to build a new factory and things like that. But I think the one thing the government can do is to be much more effective at infrastructure spending. And so,
but the government has set up, the infrastructure trust, so to speak. You've had allocations increased to Narega. The government has done its bit in allocating adequate capital, don't you think, and increasing those allocations in due course?
The allocations have increased, but the deployment has not.
Oh, okay.
So I think that what we'd like to see is a lot more deployment of that capital, of actually building stuff on the ground, putting money to work, employing people, things like that.
Okay. And so do you believe that it'll still take a while for the infrastructure story to pick up in India? And for now, it would not be led by the government through public spending. It will largely be led through the private infrastructure players? I
think so. I think it has to. But I think the problem is that if you go back to the previous infrastructure cycle, 2002 on 2005 and stuff like that, the way that happened is effectively it meant a lot of the private players deployed a lot of their own capital. They got left out to dry.
Yeah.
And so they don't have any ability to raise capital for the most part. So there's a capital starvation for a lot of the players who would be major infrastructure players.
Yeah, but many people would say that, with this bank recap, plan being put in place and its implementation, aside of, some of the private banks having recapitalized themselves, that there would be adequate supply of capital, but the demand is not coming in. The private players are not coming in saying, look, we've resolved our debt problems and we need more capital to expand, because there are a slew of projects that need to be executed and order inflow is only increasing.
It's true, and that's exactly why I called for the animal spirits. You need something to break that cycle.
What is that something in your view? Because you've seen so many of these cycles in the past.
As I said, sometimes it's the stock market going up itself, which enriches people, and therefore they feel, they can deploy capital. And sometimes it's government pump priming. It's the government actually pushing money out, in making it happen.
Okay, if you're saying that the market has more headroom from here, what can that do for valuations? Because we're already at 2021 times with earnings growth really lagging behind at 9-10%. I think those are the running estimates for FY18 as well, 8 to 10% roughly. How much can the markets continue to go up while the earnings still try to catch up?
Well, I think the other problem is that there's really two markets over here. That is, the big caps haven't really moved that much and are not particularly expensive. I mean, they're not cheap, but they're not particularly expensive. But it's really the second and third tier stocks which have gone up to 25, 30, 40 times earnings. And I think that's where there's a lot of frothiness. So if I worry about the market, I worry much more about the fact that you've got a frothy, secondary, second and third tier kind of stocks. And there again, you're not seeing the earnings growth come through. They are really just mainly hope stocks, that things are going to turn around. So that's why I do worry.
No, but what's your outlook for the Indian market into 2018? If you're saying we're going to be looking at a stable global backdrop, stable US markets, maybe no shocks even in Europe, or the rest of the world, if that's the sort of environment that we're going to step into the new year with, what does that mean for Indian equities? Because we are now at talking 11,000 on the Nifty?
I think it will depend on what happens to the rest of the world markets. I think if you have a global bull market or some kind of a global bubble where the US continues to go up and the rest of the world goes up, I think India will follow along with that. If there's a crash in the US, I think India will follow that as well. So I think that the markets are very much more linked from a psychological point of view at this point. So I think that they are being driven currently less by valuations and less by kind of underlying reality and more by sentiment and things like that. So therefore I think India will also kind of move along with that sentiment. Now within emerging markets, as I said to you, we don't find India to be particularly attractive relative to some of the other places. So I don't have any expectation that India is going to do particularly well relative to Taiwan or Russia or someplace like that.
What about the PSU Bank recap program? What do you make of it? Because one of the key problems that a lot of rating agencies had with India was the health of the banking system, and that's been the case with China. It's been the case with a lot of other economies as well. But with India's domestic debt to GDP being really high, there was much need to fix the problem. Do you think the government has done enough with fixing the problem? And what do you make of this recap plan?
I think it's too little. I mean, I think that it's a good idea and it's a good attempt.
Why do you think it's too little?
It's too small. It doesn't really deal with the size. The size of the problem is much, much bigger than what they've basically announced and what they're putting into place. So I don't see it fixing the problem. It certainly helps. Okay, let's be clear. It's not going to fix the problem. It will perhaps push the problem out further because it will, in some sense, embolden some of these people to lend more money, which is a good thing. But it doesn't deal with the corpus of the problems that they have out there.
And when you talk about problems, what are you saying, that we are still not at the bottom of the bad loan creation cycle? Can there be potential of more bad loans coming in?
I don't know if there's more bad loans. I just think that the size of the bad loans that already exist have to be dealt with.
And you think the banks have not done enough in that regard? Because the soundbites that we gather is that with the series of provisioning that banks have undergone, we might be closer towards the bottom of the cycle, and with investment demand coming back, well-capitalized banks would only be able to help those companies.
Sure. No, there's no question, look, this is better than where we were. The question is it enough? And I don't think it's enough.
Okay, so what are you bullish on within the Indian market? I went through the GMO Emerging Markets Fund and the GMO Emerging Domestic Opportunities Fund. I think the total allocation, the total AUM for both these funds is about $7 to $8 billion. Is that
correct,
fair?
Yeah.
Right. Series of stocks, and GMO has been getting very active in the markets over the last 6 months. Every odd day I see in an exchange filing that GMO's bought a certain stock or the other. I look at your list of investments in India, Kotak Bank, whether it's ICICI Bank, HDFC Bank, there are a whole host of financials, LIC Housing, Ujjivan Financial Services, IndusInd Bank is part of your portfolio as well. What is the thinking with regards to investing in financing companies?
So, first of all, our basic view of how we invest in countries is largely based on themes, that we focus on themes really rather than on individual names. So it's not that any one individual name is particularly something that's attractive to us. So I consider, and have for the last few years, the most attractive opportunity for the next 10 years anywhere in emerging markets is private sector Indian financials. And that's everything from the banks to the insurance companies, the non-bank financials, things like that. And the reason is basically you have a very much of a deepening of the financial sector. And in that sense, while a lot of people have criticized the demonetization, I think one of the really big positives from a long-term point of view of the demonetization is the fact that it has force-fed money into the banking sector. And so therefore this causes a deepening of the financial sector. And that, as I said earlier on, it is precisely that kind of transmission mechanism which has been broken, and so therefore this helps that. So as I see it, the very few, the number of people who have bank accounts in India is very small relative to most other countries. You look at the loans to GDP, consumer loans to GDP is only 8 or 10%. So my point is that there can be a massive deepening of the financial sector. And Also, given that the public sector banks have all these problems, what is happening is the private sector is essentially taking market share at a fairly large rate.
True.
So, so you have this triple whammy effect, market size is growing as people get richer, market share is increasing, and penetration is increasing.
Looking into 2018, Mr. Divecha, how are you feeling about India right now? How are you feeling about the world right now as compared to the same time before we actually stepped into 2017?
I mean, overall, I just think that, markets everywhere are expensive, okay? So sooner or later, there will be a problem. Yeah. I don't know when it will be. I just know that you can't have markets be expensive for very long extended periods of time. So there will be some triggering event, which I don't know what it is, which will cause markets globally to basically go down.
Are you cautious? Are you cautiously optimistic, or are you worried?
I'm cautious. I wouldn't say I'm worried. But certainly, I don't see anything that's on the horizon that is going to cause a massive crash. But I do think that overvaluation eventually corrects itself.
Well, on that note, Mr. Divecha, thanks very much for your time. Wish you a great holiday season and, of course, good wishes for the coming year as well.
Thank you very much.